Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our February monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. You should be receiving invitations soon to our April quarterly investment forum. We had over 100 attend in January, and we hope to see you and any guests that you may want to invite there in April. Congratulations to our Olympic teams. Record for the U.S. in terms of gold medal count and gold in both U.S. Men's and women's hockey. So a lot going on. We'll kind of jump right in. Some broad themes we're following in February, the growth of the economy, earnings, and the Fed. We've got fresh news on the inflation front that we'll talk about in just a second. So the biggest of the big is NVIDIA, $4.5 trillion market cap company, reported on Wednesday and basically beat on everything as they continue to do. So this is a case where earnings continue to support valuation, and earnings is something we're paying very close attention to. If we look at last year, if we look quarter over quarter, the red bar, which is the one on the bottom, shows what earnings were expected to be versus what happened. And you'll see by almost a 2-to-1 margin, Q1, 2, 3, and 4 earnings beat on an almost 2-to-1 basis. The question is, will that continue? And the reason that's relevant is it gives some contrast to the dot-com bubble that burst some 25 years ago, where you had a scenario leading up to the tech bubble where you had an 80% earnings growth and an almost 440% stock return. So an almost 6-to-1 relationship of price return on stocks versus earnings. So basically, this was saying that earnings wasn't supporting this. Contrast that with today and the AI boom. You've got a 73% earnings growth and stock returns of 94. So much more in line, saying that the prices in the AI space have been more justified by earnings. The question is, will they continue to be? In fact, an interesting dynamic happened last year with tech stocks, which is that even though the price went up, the valuation went down, and that's because of earnings. We started at a 29x forward PE and ended at a 26. So tech stocks actually got cheaper on a forward earnings basis because earnings were so good last year. Another thing we're following is growth. Now, growth has decelerated a bit in Q4 at an annual rate of 1.4%. Some of that you could argue could be attributed to government shutdown as much as maybe a point, but nonetheless, that's coming off of 4.4 third quarter and a contraction in the first quarter. So growth broadly is something that we're carefully following. Also following what the Fed's doing, it's likely that the Fed won't cut until mid-year this year, at which time there'll be a new Fed chair. So that'll be something that's interesting to watch. It's also interesting to note that the Fed is getting close to what's called the terminal rate, which is the rate at which we'll kind of be in a more long-term pause. We're at 3.5 to 3.75 today. We probably have another 50 basis points to go before we get to the terminal rate, and we'll probably see that through 1 or 2 cuts in 2026. This just shows that once we start cutting again, we paused in January, that once we start cutting again, 1 year after is broadly supportive of both stocks and bonds. So jobs numbers were pretty good, 130,000 jobs added, and year over year, incomes rose by 3.7. So overall, a pretty good recent jobs number in January. The CPI report was pretty good at 2.4. So again, still above Fed's target, but heading in the right direction. Although fresh this morning is PPI, which measures kind of wholesale inflation, was much hotter than expected at 0.8 in January. 0.3 was what was expected. So you see CPI, which measures retail, PPI, which measures wholesale, flashing different signals. So something worth keeping an eye on. So we had a positive January that tends to be supportive of February through December, going back to 1926. So a good start to the year tends to continue on if we follow historical trends going back 100 years. However, we are in the kind of the worst of the four presidential years in the midterms where average returns are muted and the drawdown is higher. So we're in this year two midterm elections being later this year. That again, lower return, higher volatility. And we've got kind of an enhanced geopolitical risk. Kind of the three questions as we move either towards or away from further conflict with Iran is, what will happen, what could happen, and what is the market priced in? Keep in mind, in June of last year, we bombed Iran's nuclear sites, and the markets basically shrugged it off. So again, that's something that's worth keeping an eye on, is kind of an enhanced geopolitical risk as we move perhaps closer to conflict with Iran. There's a lot of cash on the sidelines, almost $8 trillion dollars. When that happens historically, that's been pretty good for stocks and bonds, but particularly with stocks. And in the bull market cycle, just to see kind of where we are today, the average bull market, the return is just under 200%, 5.5 years in length. Where we are today in a bull market that started in October of 22, 93.8% to the upside in a little over 3 years. And just zooming out even further, this kind of talks about 100 years in the market, and it basically, discusses the fact that 74 of the 100 or 3 out of 4 years the market's up. And when it's up by an almost 2 to 1 basis compared to when down. So what that's basically telling us, all of these negative years are terrible to go through. But what it says is that as we zoom out, the market is up far more than it's down. And when it's up in frequency, it's up by an almost 2 to 1 basis. We will be rebalancing sometime likely in March to kind of adjust our target allocations for changing market conditions and to get back to kind of designed and targeted risk scores. So none of this is a replacement to contact us directly. So if we can help you out in any way, please do not hesitate to give us a call. We're here to serve you. So with that in mind, with the hopes that we'll see you in April at our quarterly investment forum, we will close. Again, thank you for the trust and confidence that you place in us. Until we see you again, either on a Zoom call in our office or at our next quarterly investment forum, we hope that you're well, and we look forward to seeing you soon. Take care. Bye-bye.